I've tried to keep it simple. The four C's are collateral, cash flow, credit, and what I call capacity of borrower.
Welcome back to the Money Seed Podcast. My guest today is Carl Baker. Carl is the CEO of Infinity Commercial Capital. He's a CPA and he's into commercial lending. Carl, welcome to the show.
Thank you, Gabe. I've been looking forward to it and happy to be here. Thank you.
Carl, let's start off right away with commercial lending. So, at a high level, if I need a loan, I go to a bank. I can
hmm
get a loan for a car, I can get a loan for a house, mortgage, that kind of thing. At what point does commercial lending come into the picture? And what is the main difference between, say, commercial lending and those typical loans that most consumers deal with?
Yeah, I'd say the way I explain it is whenever you get a loan, no matter whether it's at a bank or with your neighbor or whatever, you're either getting a loan that is a personal loan for personal use, like a loan for your primary residence, or your primary vehicle or a toy vehicle. Is it a personal uh, is the purpose of the use of the proceeds for personal purposes or for business, enterprise, commercial purposes? So that's one leading indicator or one reason why you would want to get a commercial loan. And secondly, the second distinction that I make is the loan going to report to your personal credit profile? And that's usually a leading indicator as to whether the loan is a commercial loan or not. Not all the time, but if you're getting a loan for personal or for business purposes, and you don't want it to report to your credit profile, then you would get a commercial loan.
So, Carl, what does your typical client look like?
So at Infinity Commercial Capital, we do a lot of things, but I would say our typical client is a real estate investor of some sort, whether it is a investor that wants to borrow, invest in residential properties like a single family home rental property, or a duplex or quadplex, etc. Maybe they are a multifamily investor, 5+ units, an apartment complex. Maybe they're an investor in a hotel or an office or some sort of a retail space. Maybe they're a flipper, so they're doing rehab projects, whether it's on a residential or commercial property. So real estate investors, not necessarily running a Dairy Queen or a business, but an investment property, rental property.
And do you actually provide your own funds, or are you more of a broker who provides, say, services where you connect people who need money with people who are lending money?
Right. So we have some in-house capital tied in with some capital sources, but primarily we are financing advisors, brokering. We're sourcing the capital. We're representing the borrower to find the right funding path for them. And that is a distinction. And people want to understand whether a person is a direct lender or a broker. And there are absolutely pros and cons to each. A direct lender has their lending box, and if a borrower's needs fit within that box, then there might be a good fit. If it doesn't fit, then we as a broker are able to represent the borrower and find the right lender that will, meet their needs.
Most people who get started in real estate, they typically start out small, right? They'll buy like a small single family or a duplex, maybe a quadplex, etc.
Mm-hmm.
For somebody who's getting their first financing in place, what would you say are the biggest tips or biggest takeaways, or maybe some mistakes that people often make when they get their first commercial loan?
Well, we've already touched on one, and that is understanding the loan options. Many people, when they are just getting started, let's step back for a second. When you're investing in a rental property, you are starting a business. You are entering into a commercial exercise. But that doesn't mean you have to get a commercial loan. You can go to a bank a mortgage broker, somebody, and obtain a 30-year fixed rate Fannie Mae 30-year fixed rate loan that will report to your credit profile. And just understanding, in fact, many people think that's what you do. That's you go to a bank and you get your 30-year conventional loan. And you will absolutely get fantastic terms. You'll get high leverage, good terms, long stretched out period to make your payment low. And all that's great. And a lot of people think that's my only option. The downside to that is, one, you're not going to be able to scale because lenders will cut you off for those kinds of loans, number one. Number two, all of those mortgages will end up on your personal credit profile. So it could dampen your ability to conduct true personal business when you go to seek financing for your primary residence, to buy another car. All those things enter into your credit profile, and you're running the risk. I'm not saying that the sky will necessarily fall, but in certain cases, it will impact your metrics and impair your ability to get those that personal credit. So that's number one. And then just understanding, and I know we'll get into other things, but just understand those options, and then really understand the deal. And I'll not spend 20 minutes on that, but just really understand the numbers. What is it that you're buying? What is your objectives? How does it align with your goal? And just go into it with eyes wide open.
Yeah, I've had a guest on the show a few months back, and he was a real estate investor who got started just before the 2008 collapse. And he
Mm.
made that mistake of taking out a lot of loans on his own personal name. And when a lot of those
Mm-hmm.
investments were not performing in 2008, he was personally liable and had to go through bankruptcy. And um, so that's another thing. I mean, when the market's going great and the business is great, it might not seem like a bad idea to get those 30-year loans in your own name. But when the market turns, it could put you in a tough spot.
Right, right. Yeah.
Yeah, and getting back to positioning yourself so that you are in a good, you have a good chance of getting a loan. I know that you often
Mm-hmm.
talk about the four C's. Tell us,
Mm-hmm.
what are the four C's?
Yeah, so every lender talks in some version of the four C's. Some call it seven, five. I've tried to keep it simple. The four C's are collateral, cash flow, credit, and what I call capacity of borrower. And that capacity of borrower encompasses a couple different things. It encompasses your experience. It encompasses your cash reserves, your liquidity, your personal financial statements, just your overall wherewithal to conduct this transaction and potentially conduct this transaction in conjunction with everything else you have going on. You want me to elaborate on those four C's, or?
I think the cash flow part of it seems pretty straightforward, right? You want a proper good
Mm-hmm.
cash flow.
Mm-hmm.
In terms of some of the other ones, maybe take us through some of the other ones just so that we have a clear picture of exactly what you mean.
Yeah. So the other thing I was going to say is there are four C's the way I articulate them. And trust me, every lender has some version. They're trying to fit a borrower scenario into their box, and they're fitting it into these C's. And they get so used to it, they may not articulate it that way, but that's what they're doing. And they are not necessarily going to provide equal weighting to all four of those. A hard money lender that is primarily looking at the subject property, they may not even care about credit, or they may not even care about cash flow. They're really wanting to understand what the collateral is. So my point there is there's not necessarily an equal weighting. It depends on the asset class, the scenario, the lender, etc. So collateral is in terms of real estate, it's the subject property. What is the property worth? How much did you pay for it? And depending on the scenario, some lenders won't care how much you paid for it, and they'll set that aside and evaluate the loan in conjunction with the value of the property as opposed to what you paid for it. And in some scenarios, it's the exact opposite. They will put heavy weighting on the purchase price, and because that is deemed the value. If the purchase price was if the purchase was done last week, then there's a general view that that's the value. If two people looked each other in the eye and negotiated a fair price at an arm's length distance, then everybody's going to conclude that's fair value. So that's what collateral is. Cash flow is what is the cash that is coming from that property. A very simple rental property, what are the rents? And from those rents, what are you paying for insurance and taxes, maybe other expenses? And that net difference is your cash flow. Does that cash flow, is that cash flow enough to pay to support the debt payment that will be on the books? And that's an evaluation. Credit is the third one, and credit is your credit score. Very simple. In this particular case, what's your credit score? Your FICO credit score.
So
And
typically,
no, go ahead.
sorry, I didn't mean to
No,
interrupt.
no,
Go ahead.
no, it's fine.
I was just going to touch a little bit up on the credit score, right? Because
Hmm.
let's say hypothetically, if someone comes to you and they say, Carl, I have this really good quadplex. I've run the numbers. It's going to cash flow. It costs X amount of dollars. What can they expect? What kind of credit score do they need to have? And what kind of loan to value can they expect? And what should their expectation be going in?
Yeah, that's a great question. First of all, it depends on if you said that it is a rent-ready project where a tenant is coming into the property and they're just going to live there, put up with a 1-year lease, let's say. Typically, whether and we have to talk in broad terms here, but typically a borrower is going to need to have somewhere between a minimum 660 to 680. So I use a rule of thumb 680. In fact, one capital markets guy recently told me that the market has tightened up. The market is fine for A grade paper, meaning the borrower population is solid. So 680 is a typical minimum, and for commercial, rule of thumb, commercial properties for a single family home like you just mentioned that has a tenant, 80% in a loan to value. So the way I describe it is the rents need to cover the debt service and the expenses with a cushion, and that's how lenders will look at that. You've heard the term debt service coverage ratio, and every lender does that a little bit differently, and then every accountant does that a little bit differently. But generally, cash flows in divided by debt service payment out, that needs to be greater than 1.0, typically 10, 20, 30%. So that's the way that's evaluated. And as long as that happens, typically on a commercial loan, rule of thumb, 80%. Contrast that with the temptation to get a personal loan where you might, in that very same scenario, you might get a 90, 95% loan. The rate would probably be 100 basis points. So in today's market, instead of 8%, the rate might be 7%. But again, that all sounds fantastic as long as you're aware of the fact that the mortgage is going to show up on your personal credit profile.
What are you seeing right now in the market? I know it's a little bit crazy with interest rates being as high as they are. Some people are saying the economy is fine. Some people are saying the economy is not fine. What are you seeing right now, both in the lending space and in the real estate space?
Well, so interest rates have been a little up and down lately. Of course, the Wall Street Journal prime rate has not moved in a while. Everybody's waiting to see what the Feds are going to do. I mean, what the Federal Reserve is going to do with their borrowing rate. I would say 6, 8 weeks ago, it was a foregone conclusion that rates would probably go down. It depends on who you asked, 100 to 150 basis points over the course of the year, based on economic data and based on the fact that this is an election year and just the political pressures that nobody wants to admit but are really there. Then as remember, the Fed will justify rate reductions when the inflationary rate gets to the level where it views the economy to be stable. Recent economic data has come out in the last 4 weeks or less that have indicated inflation is still a little bit higher than what they wanted, and the unemployment rate is still a solid number. Kind of contrary to intuition, they actually want the unemployment rate to increase before they lower rates, and the unemployment rate is still at rock bottom levels, 4 or under %. And so there's this view that the Fed doesn't have any reason, based on what they've been saying for years, there's no reason to lower the rates anytime soon. And I think that's still the case. And if you listen to all the investment banks and the economists, they're buying into that. And then they say, but there is other reasons as to why. And I actually think rates will go down. As to whether it'll go down 150 basis points, I don't know. But I do think there will be political pressures, because one other thing, the high inflation rates impact you, me, the man on the street. And to an extent, the Federal Reserve doesn't really care about that. They're actually wanting more unemployment. They're wanting some of those pressures, but they're also hurting the federal government with increased rates and increased borrowing costs. And there's pressure there. There's pressure on the stock market. So I think those things will cause the decision makers to lower rates, sort of contrary to all the other things they talk about. That's just my opinion.
Yeah, Carl, I
Long,
believe
long
that you,
explanation.
yeah, no, I believe that you also do financing for small businesses as well, not only real estate. And I want to talk a little bit more about how do you solve the collateral part of lending when it comes to a small business?
Well, sometimes you don't, and you lend on the historical cash flows only. Remember, with the four C's, if there is no collateral, then certainly that will eliminate some lenders. Some lenders say we are only a collateral-based lender, and so we're just not going to lend to a cash flow oriented business. But some lenders will get familiar with that business, and I'll give some examples in a second, and they will lend in that business. And I'll give those examples, but also there are other ways to solve that problem. Maybe the personal guarantor, the primary sponsor of the loan, may have to give up some personal collateral to offset the lack of collateral on that are inside the business's book. So that's another way. An example: professional services firms, home health agencies, healthcare agencies that are providing great services, but there's virtually no collateral. Those types of entities have a hard time getting traditional bank business lending because of the lack of collateral, and so they have to find other sources. And there are other ways to do that. They might factor their accounts receivable. They might use unsecured lines of credit. If they've been in business, they may establish a relationship with a bank, and the bank might just get to know them really well and extend them some credit.
Carl, I believe that you are a real estate investor yourself. Can you tell us a little bit about how you personally got into real estate investing?
Sure. Yeah. I stumbled into it. I can't say my first take on it was intentional. Just have to confess that we really just bought some properties because we wanted to. It started out as a second property for my wife and I, and then we, over the course of time, moved away from there and converted those to rental properties. We also, the our weekend spot had a a second unit to it in the duplex, and a person moved out, and so we sort of made a defensive move to purchase that to prevent somebody else from buying it. To be honest, that's not really the answer that you were looking for. We also wanted to truly be in real estate and invest, so we had some funds available, and everybody has to make a decision as to how they want to invest. And do I really want, at this stage in my life right now, do I really want to be involved in contractor projects, rehabbing, replacing toilets, plumbing, electrical, fielding phone calls from contractors about those things? I really don't. So I don't want to be involved in the rehab projects. So I bought some, I had the opportunity to purchase some turnkey rental properties. And we use some of the lending products that we offer. Just selfishly, I tried to go to banks just to get an understanding as to how our lending products stacked up. And our rates were actually, just honestly, they were about the same, but the contrast between what banks do and what we do made our loan, for me personally, advantageous. We offered a 30-year money as opposed to 20 or 25-year money. Actually, banks tend to offer 5-year money with a 20 or 25-year amortization. And so my payment was lower as well as a very competitive rate. So I just made that decision to do that. My next iteration will be to do more of the BRRRR method, the rehab based projects, because you buy at a lower level, you have less money involved, and then you infuse some equity into it through sweat equity, contractor equity, and then take money out of that. I firmly believe in that path, and it doesn't fit in my life right now with my lending, but that's my next chapter.
I think that brings us to an interesting point where you mentioned that you offer some solutions that banks don't, right? Because for commercial lending, banks typically offer 15 or 20-year amortizations. They reset your rate every 5 years, whereas
Mm-hmm.
it sounds like you can offer slightly different amortizations and then you can fix rates for longer. What other differences can some people expect when they work through you versus a bank?
Sure. So it's important to understand why, in my opinion, why those differences exist. Again, so that you understand that it's not um, just so you understand what the reasons. Banks are lending money from the deposits that they're bringing in from your paycheck, my paycheck, everybody's earnings. You take them to the bank and you deposit those. That's a deposit on the bank's balance sheet, and then they accumulate that with prior earnings, and they set it aside, and then they lend it out. And because at any given point, a person, you, me, 100 other people in the community could come into the bank and ask for all of that money back. It's very short-term money. So banks don't have the ability to lend on a long-term basis. They need that money coming back periodically. So I think that's important to understand. And so for that reason, they're lending at 3-5 year terms for their best borrowers, maybe 7-10 years in past years. Actually, now that's just really not heard of over the past couple years. But that's important to understand, that where that money is coming from and why they need to keep it relatively short term. But they're also keeping it all on their balance sheet, and it affords them the opportunity to have some pretty flexible deal scenarios for their qualified borrowers. Our capital is essentially coming from the bond investment market. So we put money onto the street in the form of a loan. Then we sell that loan back to the bond investment market. And when we sell that puts money back into our balance sheet, and that creates a revolving flow of funds that allows us to put more money back onto the street. Because of that, and because of the appetite in the bond institutional market, there is a expectation for a longer return, and there is an appetite for that. So because of that flow of funds in the bond institutional market, we're able to offer 30-year fixed rate commercial loans as opposed to the 5-year with 20 or 25-year AM. We're actually fixing the rate for 30 years. So the rate is competitive, but then it's also a longer term, which helps a real estate investor enjoy a lower payment, which is what most people are wanting. They're not necessarily trying to pay down the debt to zero as fast as possible. They want the low debt service payment to maximize their cash flows.
And do you have a minimum deal size that you require?
Well, I would say technically our minimum deal size is 100,000. We prefer, a couple 100,000 or above, but we certainly do 100,000. We're just as comfortable working on, believe it or not, in some of our other commercial property financings. We're just as comfortable helping clients with $20-25 million projects. I'm working on $20 million projects, $5 million projects, $100,000 loans. It's kind of all over the place right now.
Switching the topic a little bit to personal finance, you're an accountant, you do accounting consulting, you're a CPA, you're also a real estate investor. How do you look at your own personal retirement finances?
Mm. Well, I look at it. I have a set of books. I have a personal financial statement. What gets measured gets managed. So that's important. And my wife and I do a pretty decent job of um, spending wisely. We've been afforded the opportunity to invest in various places, not only in some real estate. We have a small investment in a syndication. We've invested in the stock market, just diversifying those. And a lot of people have different opinions as to where your money is. For us, it's diversified in multiple sources. We look at that, and we certainly want to maximize our retirement savings in whatever way, whether it's through, my wife actually has a W-2 job. And so that gives us the opportunity to put some money away into an employer savings account. That's nice. And that goes into the stock market. So we're well diversified, trying to put as much money into our savings, and just trying to think wisely about the things that a person has, and use the funds wisely.
And do you have any rules of thumb on just say proportions or percentages, like what percentage of your retirement portfolio is say in precious metals versus stocks versus mutual funds versus real estate, and how should people look at that?
Mm-hmm. Well, it's going to be different for every scenario and for every age group. So I'm personally over 50 years old, and most of my non-real estate investment portfolio, up until about 4 years ago, was in the stock market and relatively high growth. It was a mix of international, U.S. domestic growth, U.S. domestic small cap, large cap, all the typical buzzwords that you hear about and that you're able to study. When I turned 50, my financial advisor said, now you need to start taking some of those growth funds and monetizing those and stabilizing those and converting them to more stable bond funds or some stable real estate funds. So we had enjoyed quite a bit of growth in our portfolio for a while. Excuse me. And the financial advisor's goal for us, because we were getting older, was to capture those gains and make sure that they were not subject to the volatility of the market, and stabilize them and set them aside. So we started doing that 4 or 5 years ago. It was a little bit of an awakening for us. Oh yeah, I'm at that age where I maybe don't want to have all of my money in a high risk portfolio. But I think understanding that, understanding where you are. If I'm 20 years old, I frankly, without being technical, I want to have as high growth as possible. If I'm 70 years old, I can't afford to have my money be subject to the volatility of the market. And then, in between there, you have a mix.
Carl, that's some great advice. As we move to wrap up this interview, Carl, where can people reach out to you and where can people reach out to learn more about Infinity Commercial Capital?
Thank you. Sure. Our website is Infinity Com Capital, Infinity COMM Capital.com. Phone number is 314-403-7745. You can email me at kbaker@infinitycomcapital.com. Gave the website. The only other thing I would say is if you're interested in any of the things that we've talked about, I actually have started a podcast called Infinite Returns, commercial real estate investing. If you just look up Infinite Returns, commercial real estate investing, you'll find a podcast sponsored by Infinity Commercial Capital. You can find me on LinkedIn pretty well and other social media.
Sounds great. I'll put those links into the show notes. Thanks very much for your time today, Carl.
Oh, thank you, Gabe. Enjoyed it.
Hey, thanks for joining us for another episode of the Money Seat Podcast. Please remember to click like and subscribe. It really helps spread the message to other investors and it helps attract new viewers to the show. We appreciate your support. Thanks very much.